Did you know that there is more than one scoring model to calculate your credit score? The two models used to calculate your score are FICO and VantageScore, and lenders may look at one or both of them when making decisions to issue credit or to approve you for loans. On top of that, there's different versions of FICO and VantageScore, like FICO 8, which is the most common, but it isn't the model that most lenders use when checking you out for a mortgage loan. That's typically going to be the FICO 4 model. And then there's also the VantageScore 3.0, which is where your Credit Karma score currently comes from. But VantageScore 4.0 is already out and gaining traction with certain lenders. So what does this all mean for you as a consumer? Hey everyone, this is Cody with RentReporters, and that is a whole lot of information, so let's go over the differences between the models, how the scores are calculated, what you really need to pay attention to, and what you don't need to worry about. So at the most basic level, FICO is a model developed by a company called the Fair Isaac Corporation, which was first introduced way back in 1989. VantageScore was developed by the three major credit bureaus, Experian, Transunion, and Equifax, and was introduced in 2006. These companies gather data from a bunch of different sources, your credit card payments, your car payments, student loans, houses, in order to predict someone's ability to repay a debt in order to help banks and brokers make lending decisions. Do you get approved for the loan? Yes or no? And if so, what is your interest rate going to be? Now, it's really important to note that while they're separate companies with separate models, they actually all share data with one another. FICO, for example, bases its scoring model on credit reports from millions of consumers. And where do they get that data? From Experian, Transunion, and Equifax. But even though they use a lot of the same data in their models, they don't treat the data the same, which is why there's so many different types of models. FICO and VantageScore both use the same 5 credit score factors to calculate your score, but there's some differences in the weight of each category and in some of the specifics of what they look at. So let's check those out and then go over what you really need to focus on when building your credit. First up is liking and subscribing to our channel. It just takes a second and it helps us reach new audiences who are trying to improve their personal finances. By hitting that little thumbs up button and subscribing, you're actually helping someone else out who's in need of valuable information. So really, liking and subscribing to our channel can actually count as your good deed for the day. Alright, so actual first up is payment history, which is always the most important category. When looking at your payment history, FICO and VantageScore both consider how late your late payments are, the number of accounts with late payments, and the number of payments missed on an account. But what's different is that FICO treats all late payments the same. VantageScore, however, gives different weights to different types of late payments. A missed mortgage payment, for example, hurts your score way more than a missed credit card payment. Both are still bad, though. Next is length of credit. FICO and VantageScore will both calculate the length of your credit history as an average age, but it takes less time to establish a credit score with VantageScore than with FICO. So if you open up a new credit account and you have 0 credit history, you can actually go from having no score to having a score with VantageScore in just 1 to 2 months. FICO, on the other hand, requires at least 6 months of credit history, and at least one account needs to be reported to one of the 3 credit bureaus within the last 6 months. Again, Equifax, TransUnion, or Experian. Now let's look at the types of credit category. Both FICO and VantageScore reward you for having a diverse credit profile with different types of trade lines on your credit report. Trade lines can be car loans, student loans, credit cards, or even your rent if you use RentReporters. VantageScore considers recurring payments like rent, utilities, and phone bills, meaning that you can get a credit score even if you have very limited credit history. FICO 8 and earlier only consider mortgages, auto loans, and student loans. FICO 9 and 10, however, do calculate recurring payments like rent, just like VantageScore does, and we expect those models to be used more in the future. Next is the credit usage or credit utilization category. Now this is the 30% rule that says to keep our debt usage below 30% of our total available credit. For both FICO and VantageScore, the lower your utilization, the better it is for your score. The biggest difference is with the new VantageScore 4.0 model, which considers your trended utilization, which is whether you usually only make the minimum credit card payments or if you pay your bill in full every month. FICO and the other VantageScore models do not take that into account. And finally, are recent inquiries, which is how many times you've applied for credit recently. VantageScore and FICO both penalize consumers who have multiple hard inquiries in a short period of time. The difference is with how they deduplicate them. Deduplication is when you apply to multiple lenders for the same type of loan, like a car loan when you're shopping for rates, which then results in multiple inquiries. Deduplication, however, will actually wrap all of those inquiries up into just one inquiry that shows up on your credit report. It's a good thing. FICO uses a 45-day span to deduplicate your credit inquiries, while VantageScore is only a 14-day window. So if you're shopping for a car or home loan or a credit card, try to do all of your applications within 14 days to reduce the impact on your credit score. So what do you really need to focus on between these two models? Should you try and optimize for one model or another? Should you make different decisions depending on the model that the lender you're talking to is using? Since FICO 8 is so common, is that the only one that matters? The short answer is no. You don't need to worry about all the nitty-gritty details, but you do need to pay attention to both your VantageScore and your FICO score. For the most part, those 5 credit score factors are all treated very similarly in all the different scoring models, but you should be aware of how and when your data gets used. Your credit data is used by so many different companies for so many different reasons, and certain companies might use one scoring model from just one company for one decision, and they'll use a different model or a combination of models for another decision, and you really can't predict when that's going to happen. For example, even though FICO 4 is common with mortgages, the broker that I used for my mortgage only looked at my Transunion score. So here's what you really need to focus on. First and foremost, pay the bills that get reported to credit agencies on time. Pay all of your bills on time if you can, but if you can't, then really make sure to pay the ones that get reported. That's going to be your credit cards, mortgages, car payments. Those are the big ones. If you're in a tight spot, then make sure you understand what a late payment really is with that company. Your rent, for example, might be considered late if it's not paid within 3 days of the due date, but it won't count as a late payment with the credit bureaus unless it's more than 30 days past due. But do your best to pay on time, and also don't max out your credit cards if you have them. Keep your utilization as low as possible. If you can do those two things, then you take care of at least 60% of your credit score factors, regardless of whether it's VantageScore or FICO, and regardless of which version of the model that they're using. The next thing that you want to do is remember that your data will likely be shared between the different agencies anyways. When you hear someone say it's only your FICO score that matters, that's just not true, because FICO gathers data from Transunion, Equifax, and Experian. They're just using it differently, and even though their models are used in a lot of situations, you never know which model will be used with your specific situation. So assume the data that you see on one credit score report is being taken into consideration by the other agencies and banks that you may be talking to. If you remember to pay your bills on time, don't max out your cards, and just assume that all the data on your credit report will be taken into consideration, especially as data from alternative data sources become more widely used, then those are the most important things that you need to focus on. So until next time, this is Cody with Rent Reporters, and I will see you in our next video.